One of our top traders recently spotted a great opportunity in AMC, and he decided to express that trade using weekly options that were expiring that day. I'm Seth Freudberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our desk have a full understanding of how to apply option strategies to day trading ideas that both enhance the return potential of those trades and at the same time cut the risk if they're wrong. So if you're interested in how pro traders use weekly options to capitalize on day trading opportunities on volatile stocks, then stick around because you're going to find this interesting. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so it's no secret that day and swing traders have gotten very interested in what are known as meme stocks, such as AMC, and a number of the top traders on our desk are heavily involved in trading AMC using both shares of AMC as well as options derived from those shares. Now, in this case, our trader Max bought what are known as put options in order to capitalize on what he thought was a setup for an intraday sell-off in AMC. And so we want to make sure that everyone watching this video understands how put options on stocks work. This is going to be quick, so those of you who understand put options, just hang in there. We'll be back to how this trade played out in a minute. Okay, so what's known as a put option on a stock entitles the buyer of that option to sell 100 shares of a stock that he owns at a certain price called the strike price of that put option, regardless of what price the stock is actually trading at when he exercises that right. The buyer of the put option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go way below the strike price of the put option, in which case the buyer can exercise his option and sell the shares at the put option strike price, which is higher than where the market is trading. So even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put, which of course saves him a lot of money compared to whether he didn't own the put and he's stuck suffering a much larger loss on his shares. And so the premium of the put option reflects the risk that the put seller has of the shares going much lower than the strike price of that put. So all other things being equal, when a stock price goes down, the price of a put option for that stock will go up because the put seller's chances of taking a loss because the market has blown through his strike price is getting larger as the stock price falls. So in this video, Max is going to be talking about buying put options on AMC stock, and those puts are expiring the day that he's making the trade. So for example, he talks about buying put options with a strike price of $29 on AMC for a price of $1.15. So let's break down what he means by that. Let's say Max buys 10 puts on AMC for that price. Well, $1.15 is the price per share, and a put option provides you the right to sell 100 shares at the strike price. So you multiply that by 100, and you're buying 10 of those. So that would be a total cost to Max of $1,150. Now, before we move on to Max's explanation of how he uses put options to capitalize on a sell-off in AMC, I'd like to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. So Max, why don't you run us through the AMC trade?
Absolutely. So during this sequence for the week, we saw that AMC was gapping up for the third straight day. So the stock started out around 13 bucks that week, and then on this day it was gapping up and it was pushing up to around 35 in the morning. To me, what this was saying was that this was a potential blow-off move, meaning that anyone that was short the stock is probably closing out their short trade, and then once they're done, the stock should then fade back down to a more reasonable level. So that was just overall the basis for my bearish bias. Now the next point is that around mid-morning it was holding sub-VWAP, which is basically the average price that was traded during that trading session. And this was the first time during this week where we really saw this actually play out. A sign to me that there was a possible change in character for the stock and some sort of confirmation for my bearish bias.
So you mean AMC before this point during that week was never holding below VWAP? VWAP, it would bounce right above it pretty
Yes.
rapidly. So here it was holding there. That was telling you that this may be serious.
Yeah, exactly. And at this point, because the stock was settling down, the implied move for the rest of the trading session became less. So therefore, the costs for buying premium also became cheaper, which therefore increased the risk reward, or made it more favorable for buying premium as my way of putting on my bearish thesis.
So just because the options, the stock was settling, it brought down the implied volatility, I assume, for the puts and the calls. And so you got this great situation where the puts were actually dropping in value just when you wanted to get short.
Exactly. So now just going over to the chart, what we can see, here was that week where we started out in the mid-teens and then went up to the mid-30s.
Was this that first week of this AMC short squeeze?
Yeah, so this was the last week of May.
I see. Okay.
So here's just kind of a 5-minute viewpoint where you can see that the first move up got the stock up to around $35-ish. Then it consolidated over VWAP, which is what it was doing throughout this short squeeze. And then finally, it dropped down to around 28, and then it was consolidating in that 30 to 32 range, right. And that was under VWAP. So now there was that change in character, which signaled to me that it was time to put on the trade. So then actually going through what the option trade was. When I first put on the 29 puts, I wanted some way to put on exposure for this bigger idea. But I didn't want to go too far out of the money because I wasn't sure how much the potential was, and overall my target was it just going red. It wasn't something where I thought that we were going to go back down to 20 or where we started. So buying the 29s for $1.15 made sense, because if we did fade back to red or basically break even on the day, those would have paid out around 200%. So then as the breakdown started, what that told me was that there was some sort of a confirmation that if I was going to be right and we saw this move develop, it was probably going to be pretty quick. And if it didn't develop from there, it was probably going to end up being more of a range-bound day where we're just going to settle in around that 30 area, which was VWAP. So what I did was I sold those 29 puts to lock in the profit and my cost, and then I used the proceeds to then go and buy the 25 and 26 puts. What this does is it gives me a convexity, which means that as the stock is falling, I'm getting more and more short because the option delta is
increasing.
Increasing.
Right.
So the thesis there is that if, let's say, we break down through prior low, which was around 28, that the stock should quickly fall back to red, and that quick move will also result in an increase in the implied vol, which will therefore show more in those out of the money puts. Right. So what I did was, as the stock was falling down quickly into that, at that point of being red, in that 25 to 26 area, in the moment I had to decide whether or not I thought that the stock was exhausted or not. Because if it was and it grinds back up, not only will the option fall back down because the stock's going back up, but the implied vol will also fall because now the stock is going back to grinding mode.
Right, and time's running out. Those
Yes.
options are expiring that day. So you got
Exactly.
everything working against you if the market rallies.
Exactly. So in the moment, I first scaled out of the 26s and then scaled out of the 25s. So this way, I'm sort of keeping on that convexity with holding on to the further out of the money options while locking in more of the premium with the ones that were further to the money. And overall, I believe that the 25s and 26s were each around 100 or 200% gain, and so was the 29s. And throughout the trade, I was able to feel very comfortable because I was constantly locking in premium rather than, let's say, having all of the risk open. Whereas if it did grind back up, which it did, and the stock ended up closing a little bit above 26, so if I held the 25s and 26s, they would have went from a decent profit to a full loss.
Right. You would have gained nothing from those 25 and 26s. Your only profit would have been whatever was left over from buying the 25 and 26s from selling those 29s earlier.
Exactly. So as you can see here, just by these bubbles, the first bubble there illustrates when I'm buying the 29 puts. As you can see, it's consolidating, and this is more of me making a prediction based on the just the pattern. And then finally, when we break down, we can see just by the action so like as it was breaking down, the price starts to get more volatile, and this is a sign that this is sort of do or die for the stock. If then we made that new low, and then it just kind of grinded back up to VWAP, it's probable that that was just a false breakdown and that this trade wasn't going to go through. But as you see here, once we broke down, the stock quickly accelerated, and basically on every overextension, which means that every time that the stock fell a good amount in a very short period of time, I would slowly close out the trade. And I believe that the ATR on the stock, which is the average range for the stock in one trading day, somewhere in like the 5 to 7 range. And you can see from VWAP, it basically fell 1 ATR, which also coincided with my target of it going red. So in that area, I knew that because this was a quick move down to the ATR target, this was probably the spot where my trade was going to be around the maximum gain, and it would be smart for me to take this trade off. And overall, yeah. And then I didn't really do anything with the stock later that day. Just a quick recap. The 29s were basically a 75% profit when I rolled them out. And then I sold the 25s and 26s for 100% each. Overall, I believe that I used the proceeds from the 29s, so those 25s and 26s were risk-free. And the biggest thing for the 25s and 26s and just any out of the money options is knowing your time restraint as well. Because if, let's say, that the stock flatlined after being at that prior low, there's a good shot that I would have taken off those 25s and 26s for flat or a small loss if it was just consolidating, because I know if the stock is not going to go down quickly, I'm just going to be burning cash every minute that goes by.
Because of the time decay.
Exactly.
There's a 4 o'clock deadline on this, right? Unlike every other investment vehicle, there's not necessarily a time deadline on it. With options, these expire that day, so you got the gun of time pointing right at your head, and you got to deal with that. Mm-hmm. And I just want to say you dealt with it really well, because you took advantage of the fact that as the stock was selling off, you were getting that blow up in options volatility, and you were getting a blow up in the deltas of those options also. And so you understood how those Greeks work, and you were taking advantage of those, and those were at that point overcoming the fact that those options were about to expire. So the delta and the what's called Vega, the options volatility, were overcoming the power of the time decay at that point. You kind of understood all those dynamics, and you hit out of those in time so that the decay of the options wasn't going to hurt you. In fact, you took advantage of the delta and the Vega at that point. Exactly. So that was what was one of the most really impressive parts of this trade.
Thank you. And yeah, then everything else, for the most part, we went over, just kind of explaining what my attitude was as AMC capitulated down into my price target, and just my thought process in that moment, feeling out how overextended the stock was, and just every moment, what is my risk reward. And then finally, when we're kind of in that 25 zone, I was like, overall, my risk reward for keeping this is not there, and therefore I should take these off. and lock in the profit. And if, let's say, something else set up, I can always put on a different option trade later or use equities need be. So just kind of more so what I'm looking for a blow-off characteristic. First, a massive short squeeze. So what this means is when there's a stock that has a huge short interest, meaning that a good percentage of the shares outstanding or the flow, people are short, and then the stock ends up blowing out to the upside, forcing people to close out their short positions. Usually that upside momentum is because there are shorts that are covering. So when you can figure out when that forced buying pressure is over, most likely there's not going to be that much buying demand until it comes back down to a more appropriate price. And you can get this, or you can try and figure out when the blow-off happens using volume or using price patterns. Everyone has their own way of doing that. For me, seeing that there was a blow-off in the morning and then holding under view up was my signal that this was a change in character. And then if you just quickly go back and see a more meaningful price point, you can see that the prior day that the stock ended up basing above 25. So that was also where close price was. So it made sense that, one, people that were short, where would they start to cover? Probably the last point of support. And then two, where would there be dip buyers that would come in? Also that prior level of support. So just given those two factors, that was the appropriate price target, especially because I only had that 1 day. That also made sense. It's not as though that I could have kept it for a few days and see what happened. I wanted just to be smart about that. So overall, just for the trade review, I'm very pleased with the trade, as the weekly puts was a way for me to give myself exposure to the bigger idea. Because my experience with AMC is one where it's not really a clean trader, which means that it will wick out, at various points. It will basically try and just force people out of trades by blowing through common stop points. So let's say there's a clear point where you think everyone is short versus, it'll just wick it out, then go back down. So just realizing that I didn't want to put on a trade where I would be forced to stop out at a certain point, but rather putting on a trade where my premium is my risk. So effectively speaking, my stop was just that amount of risk that I used for the premium. I felt that that was a more responsible way of doing it, which is why I used options. And then once I felt comfortable, I rolled out the options to give myself some more speculative exposure. I think that going back, that the only thing that I would potentially change is, instead of making this trade risk-free, it would be to actually add risk. One could say that because that breakdown of 29, that was a sign that I was right, and instead of sizing down, I should have put on more risk, and that, for the next trade, that is definitely something that I will consider if I see similar signs.
Right. Although, I wouldn't beat yourself up too much about that. First of all, it was a great trade. Second of all, there's an argument that you did put on more risk. You just rolled where that risk was located in such a way that you came out with a guaranteed win no matter what, but with the potential for a lot more of a gain.
Yeah.
So, if you feel like, well, maybe I should have taken more risk, then you could have spent more of the proceeds at the 29 perhaps and bought a little bit more of the 25 or 26s. But all in all, I think it was handled really well. You took advantage of a very quick profit on those 25s and 26s while essentially locking down that you were in a virtually no risk position on the trade.
Absolutely.
So I think it was a great job.
Thank you.
Now, one point I'd like to clarify for everyone is how cleverly Max turned this into a risk-free trade. So let's drill down on what he was saying here. Remember how Max talked about buying those 29 puts expecting a further sell-off when he entered the trade? So let's say he had bought 100 of those puts for $1.15. Well, remember, we multiply each put by 100 for the 100 shares they represent, and he bought 100 of them hypothetically, so that would come to $11,500 in the first phase of the trade. Then in the second phase, he did what options traders call a roll, which is a popular tactic among those who day trade options, where the first step is to cash in on the original put options, in this case, once they had rallied to around $2, like Max mentioned, which, as you can see from the calculation, brought in $20,000. So therefore, on the 29 puts trade, there was an $8,500 profit. Then he turned right around and bought 26 and 25 put options, which, being farther below the market, were worth a lot less than he was able to cash in on those 29 puts for. So let's say he bought 50 of each. So as you can see from the calculation and from what Max mentioned, the 26s were going for around 50 cents per share, and each contract represents 100 shares, and he bought 50 contracts. So that comes out to $2,500 for those. And using the same logic for the 25s, which cost 30 cents, that cost an additional $1,500. But the implications of this are really interesting, because what happened essentially, as you can see, is that the trade became risk-free at that point. Why? Well, think about it. He received an $8,500 profit from selling the 29 puts, but he then sort of spent some of that profit on 25 and 26 puts, which means that even if AMC had rallied after he bought the 25s and the 26s, and by the closing bell AMC was trading anywhere above 26, then both the 25 and the 26 options would have expired worthless. And even though he got no value from buying them, he still ended up with at least a gain of $4,500. So he put a floor on the trade at that point of a gain of $4,500. But in fact, as Max said, both the 25s and the 26s both doubled in value before he sold those options, as AMC had sold off further after he bought those puts, and so the put prices would have increased on the 25s and the 26s that he now owns, as we explained earlier. And so the final outcome of the trade works like this. We take the original $8,500 profit he made on selling those 29s after he bought them for $1.15, and then after paying for the 25s and 26s, we sell them both for twice what we paid for those, as Max indicated, resulting in proceeds of $5,000 and $3,000 respectively, resulting in an overall trade profit of $12,500 through, first and foremost, spotting the breakdown of AMC's price on that day, and then cleverly using options to make, in this case, $12,500, and after selling the 29s, a profit guaranteed of at least $4,500, no matter what took place after that. And so what I'd like you to take away from today's video is the fact that day traders have many tools at their disposal, and one of those is to use options to take advantage of potential short-term moves on volatile stocks like AMC without taking a lot of risk, through buying relatively inexpensive options. And then if the trade goes their way, they have the option of going into a phase two and rolling some of the proceeds from the first phase of the trade into a further bet on the continued movement of the underlying stock through a second risk-free phase where a profit is guaranteed, but a further potential gain is possible if your overall thesis is correct. Max's strategy is a great idea if you have a solid feel for when stocks are breaking down or breaking out, as the case may be, and you'd like to play the move in a less risky way than outright buying the shares. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.